Welcome, everybody, to the Q2 webinar put on by East Daily Analytics. We're going to give everyone just a minute or two here to get started, and we'll fire this up and start talking about some market stuff. So hold on for just a second. Thanks everyone for joining us on East Daily Analytics Q2 webinar on market updates. So we called this webinar The Tipping Points. I am Justin Carlson, the Chief Commercial Officer here at East Daily Analytics. Happy to join you and walk you through this. I have my partner in crime, Rob Wilson, who heads our product group, and he is here to, for a couple of reasons. One, to interject and add some commentary and insightful thoughts, and then two, to keep me honest. He's never afraid to tell me when I'm wrong. So, Rob, feel free to jump in and tell me when I'm wrong.
Will do. Thanks, Justin.
All right. Just a couple of things, housekeeping notes as we get into this. As most of you know, there's a question area down at the bottom. Please ask questions along the way. We'll cover those at the end. To the extent that we don't get to your question, we'll certainly have someone follow up with you, either myself or Rob or someone from the team. As many of you know, we like to talk to people. We like to have conversations. So we certainly want to follow up and have those. A replay of the slides, as well as a copy of the slide deck, will be sent around tomorrow. So look for that in your inboxes. And again, follow up with any questions as you start to dig through that. And, lastly, there are some links in the resource section to future webinars that we're going to be hosting. We've got a couple of really good ones coming up that I will highlight at the end of this deck. But if you feel free to, as you're listening to the talk, feel free to select those, register for those webinars. Quickly, I do want to go through this. I won't spend a lot of time on it, but who we are and what we do. As I imagine, there are people on the phone who are clients, but likely maybe new to understanding or hearing from us. We focus on connecting supply, demand, and profitability through infrastructure data and market analytics. And that's done, and how we do that is really through three components. It's supply analytics, it's demand analytics, and it's commercial analytics. And what I mean by commercial analytics is really that profitability, that understanding how systems and infrastructure operates in order to connect supply and demand, and ultimately to make money. I always like to say, connecting money to the molecules. That's sort of a key theme of ours. And then I believe that the relationships between the data is as important, if not more important, than the data itself. So you can see that multi-sourcing benchmarking, different data sets, and trying to find the story behind the story behind the data. Those are really important things for us. You can certainly see some stuff in the upper right-hand corner of this slide, talking through different data sets and modeling capabilities and all that good stuff. Key for all of you on the phone is if you're not using, down there at the bottom, our delivery methods. If you're not using data delivery, talk to us, call us. We have data delivery options. Many of you are accessing our reports and models and have come to experience some of our data visualization in our Energy Data Studio. That's number 2 there. You use that. Hopefully most of you know by now, analytics support is key to our service offering, and that is not just something we say, but something we live by. So we are client focused and service oriented. So please come call us. We'd love to talk about it. And to the extent that you need some consulting, some custom analysis, we do that and can help. Let's get into the meat of this presentation. There are several tipping points that I would like to talk through today. There's certainly a lot going in the market, and this market update is mostly based on gas. There are some tangents we're going to make towards some of the finance side, and there's some tangents towards the NGL side. So we're going to talk about some of those things, but the gas market's really interesting right now, and that's been the focus. To the extent that you want to talk about crude, we've got crude market update slides, NGL market update slides, certainly the finance side of what we do. All of those things are available. So if you or your team has an interest in digging into some of that, let us know. The tipping points for this year is 2023. It's certainly tipped, or it's on the tipping point with a balanced market, meaning we had this evolution of our supply call where late last year we were calling for massive oversupply and that we needed a price correction in order to rectify that. We had that price correction. We've seen some of the rigs come off, had that demand come up too, certainly with power. And so we've had that rectify, and we're now at this very tipping point of a balanced market. So we'll look at some of that. We'll still talk about 24 being out of balance, where we see that maybe falling out, some of the bearish and bullish ways that might trend. Haynesville certainly tipped. We'll dive into the Haynesville, some of the guidance, the throughputs, the flows, and our continued expectation that it is the balancer. Waha basis has been a big topic of conversation of late. We'll look at several of the factors contributing to that, or that we see. Certainly a lot of minimal facts, a lot of theory. We're going to work our way through some of those and see what might be contributing and talk about that. Update on LNG and SPAs, that's going to be key to the forecast into the future and a key balancing point for whether or not we need more supply or less supply as we go forward, and how quickly it impacts the market. Lastly, and I commented on this actually in the 2024 balance, but how the West got weak. I want to walk through a little bit of a scenario around the West getting weak from a pricing standpoint and what that could turn into from a dynamic standpoint visually. So those are our key topics for today. I will start off first with a high-level slide that many of you might have seen, but it's updated for sure. And it does set good context for our frame of reference for how we see everything evolving. Certainly this year, a lot of new infrastructure, PHP and Whistler at the end of the year. We've already had several pipelines come into the fold through the Haynesville. Big topic of contention, or discussion at least, was would producers fill that regardless of price? That was a big debate. I know we talked early in the year with many clients and through the market. It is obviously from producers' reactions, it is clear that they would not produce at any cost. So they've pulled back rigs, and we'll talk about that in a bit. Secondly, and this is that phase one getting long. So this is where we got long, prices came down, and we expect continued pressure on the market. Next year, we expect it to continue to get longer as Matterhorn comes online, and we've got more infrastructure coming from the Haynesville. Again, we still expect, as we did earlier this year, for producers to exemplify that same sort of reservation in overproducing into a market that can't handle that supply. So, but still, nevertheless, a lot of infrastructure available in order to support 2 new facilities coming online with Golden Pass and then Plaquemines, which, and although I may not be saying that right, so hopefully I'm not offending anybody from Louisiana or Texas, but I'm a Colorado native. That's the best I can do. I apologize. So we've moved that up. So that's definitely a change as we've gotten more certainty from them and how they're going to bring that facility online. Still a lot of debate on how it ramps up. So we'll talk about that a bit later on. And then finally, this massive build of 18.65 BCF per day of new LNG facilities in the Gulf over the next several years. One thing that we talk about often is this long-term trend of you've got 3.1 Bs of new capacity from the Permian and 6.5 from the Haynesville, but 18.5 from new demand potential, and certainly the roughly 10 that comes from new capacity that comes from new supply is not equal to the 18 that comes from new demand. So longer term, we're not going to talk about this necessarily in a big way today, but new infrastructure is absolutely necessary in order to feed that 18.65 BCF per day of new demand. There's still a lot of that materializing, and we're going to get into that deep as we get into the conversation about LNG. So let's shift into where we are today, tipping points. So if you look at that chart on the right, you've got that purple line that goes above what is our tipping point from a standpoint of full storage at 4 TCF. Roughly speaking, we've certainly gone above that in the past, but from our perspective, we were going way above it as we looked even in January. Prices came down, producers reacted, demand, as prices come down, demand gets more solid, or we're more confident in the amount of power burn that we'll have, and specifically power burn. And that's brought us back to the blue line, which you can see now is where we are right below that tipping point line, where we feel the market is within a good margin of error for balance. We published two models. We published an unbalanced model and a balanced model. Our unbalanced model is one where we simply look at supply. We hold demand at what our expectations are. We hold supply at what our expectations are, and we see what that does to storage. Depending on what that does to storage, we can make an inference on what that means for price. The balanced model says, okay, how much do we need to bring down price and thus production and ramp demand up, given that price shift, in order to balance the market? So that is the dynamic we have been looking at since last year and into this year. And right now, our balanced model and our unbalanced model are close enough that there's certainly a lot of margin for error in there with respect to a lot of moving parts within the market, from demand and supply and everything that's going on. So all of that is to say we are right in that margin. We are still very closely watching power. It's hot. I feel bad for the folks there in Texas. I hear it's sweltering, and that's certainly great for gas markets. Not so great if you have to be outside or be outside. But nevertheless, we're in a balanced market. You can see this out if you follow that forward and look next year. We are still unbalanced next year. We'll talk a little bit about that in the next slide here, or next slide or two, with respect to we still see a lot of production potential, which is where we expect continued pressure on prices to hold that from getting too out of balance again. Meaning if we start to move up with prices, then all of a sudden rigs show up, production goes up, and the market gets out of balance again. But I don't know, Rob, there's a lot you've probably been seeing in the market and talking to clients about. So if you want to jump in there, please.
Yeah, Justin, you mentioned where we are now with our storage balance outlook. When you say price, you are specifying gas, right? Because I know there's been a lot of conversation about gas and crude. But where we've seen producers react is those gassier focused basins. So you can see in the chart, rig counts have decreased by about 67 since December last year. All of those have occurred in gas-centric plays like the Haynesville, down 11, the Anadarko down 28, and the Rockies down 12. And the Anadarko does have some NGL-rich or gas-rich parts of the play like the stack, but we've seen producers react where we expect them to react in those gassy basins. So just want to point that out. Like Justin said, there's still room for duck builds or more rig attrition, but a lot of that has occurred.
Yeah, thanks, Rob. It's a good point too. When we look at that unbalanced model, our forecast for the crude basins largely is pinned around what we expect crude prices to do, which is pinned to the forward curve. And you can actually see that in that bottom count where we have a rig attrition in that bar, the purple bars going forward, that is pinned to the forward curve. So there's a reason for, and certainly thinking through upside potential or bearish sentiment, if you will, against prices that, will rigs really decline respective of a forward curve that has historically been, well, let's say it not right. Maybe, and that's certainly upside potential. Yeah, Rob?
One other thing I'll just point out there is we have seen some rig attrition through, and then I'll let you go, Justin. We have seen rig attrition through consolidation. So we did just put out a note on the Civitas acquisition in the Permian, and they have talked about kind of backdoor rig cuts through that acquisition. So that's where we have seen it through a number of acquisitions so far this year.
I won't spend a lot of time here. I realize we're 15 minutes in and I talk slow. So this is only to point out that we've seen storage go above 3.9 TCF 4 times since 2006. we expect that we will be right at that threshold here in this year. You can see historical prices again last year, 2012. It was way up there at around 340, 350-ish price range. We do not expect it to get that high, or we do not expect that it is needed. Certainly, the recent price or heat wave has stirred markets up a bit from a price bullishness standpoint. But again, we still need pressure on rigs, because producers can be very reactive, and if price curves move too far, they can react. And so, bearish signals going forward. Reduction in high power burn. We're still watching that very closely. Certainly, the heat wave helps keep that power burn levels up. Major LNG outages, we saw it with Freeport last year. Watching it with Sabine, certainly. Those are factors that we want to continue to consider. But there's still bullish sentiment from a standpoint of how far will producers continue to pull back in the Haynesville and maintain discipline on overproducing into the market. So not too much there. Skip into the power side of things. Again, I have that circled in red here, or squared off in red here as a big driver. We need to maintain those high power burn levels. You can see how it's jumped up from 2021 to today. We're in that 34-ish BCF time range. I pulled it out so you can see what it looks like on the summer load on the right-hand side chart there. So you can see the really high levels this year in April and May, respective of previous years, and then how that sort of tables out as we get into the thick of summer and high utilization on many of the facilities out there. We are about even with last year. So certainly there is some upside potential there, where you can might expect that if it could be bigger, then that pulls that 3.9 even a little bit lower where we are today. The other thing I think that's worth noting here, especially with respect to next year, is the industrial demand. It's right below that box in orange. We pulled back industrial demand next year. That's a huge opportunity for a little bit more bullish outlook. We're looking at the steel, we're looking at GDP, trying to understand how industrials react. It's a little bit of a moving target, if you will. I mean, we're not necessarily economic experts here, but I would argue that that's probably a little bit too bearish. I'd like to see that, and I imagine we probably will correct that up a bit, just because it seems a bit aggressive on the decline in industrial demand. That would allow more production into the market, so and more producers to produce. Again, I feel and we have seen producers can produce significant amount of gas to meet even that marginal increase in industrial demand. So I don't know, Rob, any comments or thoughts there on that side?
Yeah, just for frame of reference, we do look at the steel and what others are saying, and what's baked into that industrial number in 23 is about 1.3% GDP growth year over year. It's baked into the 24 number is 1%. So just frame of reference, as that outlook is updated based on macroeconomic conditions. That's kind of the baseline reference point.
You'll note here, there's some click here at the bottom of a lot of these slides. So when you get this deck tomorrow, if there's some slides or graphs that interest you, feel free to click on those. You'll get launched right into the Energy Data Studio. You can access the data sets, access some of the data visualization to the extent it's available for these graphics. So feel free to watch for those in this deck. Let's switch to the next thing, which is a little bit longer dated look out next year, and this will launch us into our Haynesville discussion next. We still expect next year is a little bit out of balance. You can see that in that top left graph, where our unbalanced model there in the dark blue line with the gray below it is above about 2 BCF, as you can see in those orange bars, above what our balanced model should say. Again, if you knock off that industrial demand, that thins to about 1 BCF, little more, but just from a perspective standpoint. So there's some moving parts there. We still think we are out of balance. A lot may come into play with respect to how quickly Golden Pass launch or ramps up, how quickly Plaquemines ramps up. But again, a big balancer on the other side of the equation could be power demand. Does it stay as high as we have it this year, or does it come lower? So we continue to watch those things respective of next year. Again, we still expect a decent lid on prices. We do not expect them to run too fast next year, simply because we're not getting while Golden Pass and Plaquemines are significant facilities and certainly change the demand profile. As you recall from the map below, then you hit a little bit of a lull in 25 before we start to get ramps again. Now, again, we could get some early LNG facilities coming into play in 25, and those are things we want to watch really, really closely. You'll note, too, on the break-evens there, we've got the Haynesville, and we've got some of the stuff in the Utica, and as well as the Marcellus. Those have Marcellus. We're not going to talk a lot about the Northeast here. We've got a lid on that. It seems to be flat. We're hearing producers talk about flat. Certainly, Architects is now down. These are below break-even prices, so you note that the current prices are certainly right in line with where those things are. So that's obviously tied to the pullback that we've seen. Let's get a little bit into Architects and hit the tipping point. We've certainly seen a lot of producers pull back in the Architects. A lot of discussion, Southwestern, Chesapeake, various other players. Year to date, we've seen that decline from about 75 to 65 rigs in the Architects. That you can see in that chart on the right-hand side. You can also see that that has increased our DUC inventory. So as we're watching DUCs, about 10 a month to about 16 a month, this becomes potential production that could come online relatively quickly in terms of a price spike, in terms of needing to feed some demand markets that need to have some gas. I think it's, if you look at producer guidance, they're down or expected to decline by about 2%. We've also, in my conversations or discussions, hearing from those producers, there's still a lot of sentiment about flattishness in 2024. So again, there was a lot of conversations in the beginning part of the year about would producers in the Haynesville produce into all the capacity they had, or would they pull back respective of market dynamics? We certainly took the stance that they're going to pull back. They're the only ones that have the ability to change the market dynamic. Otherwise, we're headed for a very bad price outlook scenario, and that's not in the best interest of everybody. And they did pull back, and we've seen that. You can see in the bottom right-hand chart, we did throw in Atheon in there. They pulled back in May, and it ticked up just a hair in June. We're tracking this in our MAT, which is our midstream activity tracker, and we put those across all systems. One thing to note that I do think is interesting when you look at that drop in the core of the Haynesville is that there was an uptick in the East Texas side of the Haynesville. Chesapeake talked about having 2x IP rates in that area. We certainly haven't seen that come across in pipeline in well data yet. It's something we're watching, and we encourage everyone to watch. That would be would change the dynamic. The IP rates that we see in East Texas, I know some comments about that being a flash in the pan, or that doesn't matter. Well, they're about 60% of the IP rates in the core of the Haynesville, so that's still a decent clip of additional production that can come online. And again, if the Chesapeake numbers are true and there's more upside there, that's certainly interesting and something we're going to continue to watch going forward. So we will shift here. Let's look at some midstream stuff and talk through what the potential is there on the midstream side of things. These are things we are tracking in our financial models as we tie this to the profitability side of the midstream sector and see what the balances and gives and takes there, and does it align. Certainly big impact to the Williams system, given that they're tied to Chesapeake and Chesapeake's pulled back. They have a little bit of a lower MVC commitment there, so some risk there. DTM is more tied to a Southwestern. They've got some offsetting upside with respect to owning pipeline capacity with LEAP, so there's some offsetting upside there. And then again, continue to watch that ET thing or ET with respect to the high volume Chesapeake wells that might come out of East Texas, because that's that ET system in the East Texas side of things that we're going to keep watching, because there could be some potential there, and want to make sure that we are aware of how that might flood into the gas market. So, Rob, anything from the equity side of things, or the finance side of these systems, the midstream side?
Yeah, Justin, I think you hit the nail on the head with Williams and their Haynesville system. It's Chesapeake and Southwestern. They have a really nice East Texas and Haynesville gathering and processing system, though. So this is more of a bump in the road in our view, pre-LNG demand coming online. The East Texas Trace acquired system in 2022 has Rockcliffe on it as a primary operator. And we did cover the pubcos as far as what they've guided to for flattening production, rig reduction. Some of the privates are reducing as well, including Paloma and Silver Hill. So these are some of the things you see on these G&P systems. But like I said, this decline in rig count on a system like Williams, temporary pre-LNG demand, and part of the reason it's down for rigs is because they have so many rigs on the system. So if some of that volume decline shows up, not a big concern for us for volume growth long term.
Yeah, that's a good point, Rob. There's a short-term dynamic, and then there's this long-term dynamic, and the long-term potential for the Haynesville is huge relative to all of that LNG. So don't want to lose sight of the long-term potential relative to the short. So it's a great point, Rob. We'll shift now. We're going to come back to the Haynesville in a little bit as it interplays with the Permian, but let's shift into the Permian for now and talk about some of the dynamics there. With the Permian, we certainly this year, and you can see that in the bubbles that'll come up here in a second, that we expect processing capacity. We've seen it; it's continuing to expand. You can see it on the right-hand chart there in the circle, where especially from the Delaware side of things, you've got, from the Midland side of things, you've got a ton of new processing capacity coming online, respective of our forecast. So that blue area is our forecast, and there's that huge gap between that yellow line of new processing and the blue area of forecast. That is all potential supply that where we may be underestimating the amount of residue gas that could be coming into the market. You can see that a little bit represented in the left-hand chart with respect to a flat rig count, where you can see that upside where we feel it's the total summed area goes above the dotted line there, where the total production out of the Permian would exceed the current capacity that is planned in the area, and we'd start to see some basis blowouts or calls for new infrastructure that could be built out in that 2025, 2026 timeframe. So we are watching those things really, really closely, because that's where we see opportunity to build new infrastructure or opportunity for basis blowouts that we need to be aware of. Now, the bigger discussion point that's impacting everybody really near term at this very moment is the fact that on the left-hand side, we have circled that capacity or production is running at capacity. Now, we intentionally do that. We look at short-term capacity expectations, and we dial back our production estimates to try to stay within that capacity limitation. Now, we're going to talk a lot about what people are looking at going forward, because the reality is the reality is that rigs have not really moved all that much. 354 in January relative to 345 in June. It's just not a big move in rig count. So rig count has remained relatively flat. And so the big question that's on everybody's mind is, when will basis tip? When will it turn negative, or may it not ever turn negative, because we've got other factors going on. So let's explore some of that. It's helpful with a place like the Permian to explore fact versus theory. We like to always talk about the things we do as fact, and often many of them are not. What we do know is fact, and the trading community often reminds me of this, is price is fact, and it absolutely is. Basis was strong. We had 8 cents back from Henry Hub last week. I mean, there's very strong basis. You can see it in that chart down below, that basis has definitely improved, certainly in the last couple of months. Another fact, we did have 2 outages, maintenance events recently. We had 2 PHP maintenance events, one back in, I believe it was early May, one that was in June. The one in May was between 900 and a BCF or so, and that did impact basis. And you can see that in that first circled area there, where basis blew out, down about $3. So you see this real big spike in basis. So we knew we hit capacity then. And then fast forward to about June, we had another PHP outage, which was 200 a day. Didn't impact basis. You don't see anything in that chart. So there's the sort of the bookend, and I think that is I'll call that relatively good fact because it's represented in the price that we had 2 maintenance events. One impacted basis markets and one did not. The other fact is, as I stated in the beginning of this, it's hot. And I've heard and talked to people in Texas that say this is the hottest that it's ever been since they remember. So it is certainly hot in Texas. That is a fact. I will not dispute any of you who happen to be in Texas that it is hot. The other fact is that we don't have a lot of good data, real-time data, other than price down there. We certainly can look at rig counts, but as we all know, rig counts aren't necessarily a perfect indicator of production. And the sample size for pipeline throughput, which we talk about a lot, is not very good. It's, I think, somewhere, Rob, if I'm not mistaken, in like the 30% range of total supply output. It's low though, and certainly respective of the system you're looking at, it can be minuscule because we're monitoring all the pipe flows on individual GNP systems, and some of them are just not very good corollary to what's happening on those systems. So that's a fact. The theory is, okay, the heat wave is causing more bullish demand. I believe in that. I mean, obviously, as temperatures increase, more cooling degree days, power ramps up, facilities need to run longer during the day, and we need to run harder. In our models, we bake in an average to 300 to 400-ish of local demand. We could see that going up to being in around the 600-ish mark. So that's 300 potentially a day of production that's consumed locally that normally would get put pressure on those export pipes. That translates also into the other theory of higher Mexico demand. So as we shift out pipes going to Mexico, that could be ramping relative to what a normal sort of cadence would be, respective of a more normal demand scenario. And we could see that adding additional, let's call it 100 or so, 100 or 200 a day of additional takeaway or additional demand on the market. The other theory that we've heard, and I talked to somebody about, was that the heat wave's impacting supply. I have personally never seen that. That's not to say it's happened, and I'm certainly not an operational expert, and I certainly can't. I imagine that, as I said before, the facilities, the processing plants, these cryos are running a lot hotter or harder to try to keep everything cooled. But again, I play an engineer on TV, so I'm not going to pretend to know that everything works exactly like that. But I've never seen it, and as I look at that chart on the right there, I don't necessarily see it in the historical numbers per se. So I'm not viewing that and saying or being able to see a tick when it gets hot in Texas. And certainly these last few weeks have been really, really hot. But even respective of everything else, I haven't seen this in the past, even when it's hot in Texas, that we see a massive slowdown. The last few years might not be a great indicator. 2020, that's a throw-out year in terms of measuring the impact of rigs and production and everything. I mean, I think we all forgot 2020. The 2021, it wasn't as hot. You can see that in the CDDs there. 2022 certainly was hotter, and we did push production with a slight slowdown during some of the months. I'll just say this, from a standpoint of production, in 2021, we're adding a little over 282 MMCF per day per month, with a Permian rig count of about 235 rigs. We were certainly burning through a lot of DUCs. In 2022, we were adding about 277 MMCF per day per month through the summer. And this is just a summer number. And that was at a rig count of 342. We were probably burning through less DUCs. Now, year to date, we've been adding 162 MMCF per day per month. So this is not a summer thing. I'm just talking year to date, January through May, at a rig count of 348. Production has slowed and this is real data, April to May, to a little less than 100. So we are seeing that slowdown. We saw that slowdown before even the real heat wave started to hit, because we're talking April and May. So, I don't know. I'm not necessarily, I'm still, the jury's out with respect to how production might really, or heat, might really be acting production, but I certainly know it's impacting the demand side, because that's, just goes without saying. The other piece that we're looking at is the ethane rejection or recovery side of the equation. So if we flip over to that, and remember we're on heat wave adding let's call it 300 to 400 additional demand between Mexico and local demand, and then we look at the ethane side of things. So on the ethane side of things, the frac spread is something if you look in the middle of that chart on the left hand side, you can see the frac spread is certainly coming down, is expected to continue to come down, but that may not be the best indicator. And just to be clear, when you have frac spreads that are really positive, generally you're recovering more ethane. If you're recovering more ethane, you're pulling it out of the gas stream. There's a good rule of thumb here that I would take note of, which is about if you're taking about 10 million barrels a day of 10,000 barrels a day of ethane out of the
gas stream.
Out of the gas stream, it translates to a volumetric standpoint of about 28 MMCF per day. So if you scale that up and say, well, what if we're taking 100,000 barrels out of the gas stream? Then it's 280 MMCF per day. So that's about a quarter of a B, or more than a quarter of a B, that's being pulled out of the gas stream. That's significant, and I'd expect a lot of that could be coming from the Permian. Some of that from the Anadarko certainly, but that's significant. And you look at that in that right-hand chart where you've got the total production of ethane through just March. So this is factual data, and you can see that there's about 100,000 barrels a day that have come out of that. Out of the ethane, increased ethane production, and that correlates to ethane exports, which have increased in the same month. So think back to as we started to slow production, as I talked about in the last graph, we started to slow that production, the residue gas throughput to less than 100 MMCF per day, correlates pretty well with when we started to see an uptick in the amount of ethane recovery, exports, and total production. So again, I think this is a key point on this topic that we'll want to continue to watch, and that the frac spread may also not be a great indicator of how much ethane is being recovered. It's still very, very important, but it may not always be the perfect, because now we've got these export terminals that are consuming. So, Rob, anything from the road that you've heard and talked to people about on this topic?
Yeah, I mean, I guess my takeaways would be bullish C2 or NGL volumes through midstream infrastructure for the players that have it. Think of Targa, Energy Transfer, Enterprise. And then that we would expect to see DUC inventories increase, and we haven't so far in the EIA data. You're correct about that. But if you're a producer and you see that 2.3 BCF a day of processing capacity is coming online, and then the residue pipe expansions that you noted earlier on in this presentation, why wouldn't you as a producer build an inventory of DUCs that you could turn in line when that capacity comes online? I know Exxon has talked about it in prior earnings calls, so it makes sense to me, but those are kind of the two takeaways I heard. DUC builds is something we'll start to see, and then I would expect strong NGL volumes out of the Permian showing up in 2Q earnings calls.
Yeah, thanks, Rob. So just from a math perspective, if you have that 400 a day of additional demand from Mexico and from local demand, and if you have increased ethane recovery, which is, let's call it around 200, now you're getting into the ballpark of 600 a day. That's significant. That could impact the Permian and the how we are impacting, or how basis is reacting relative to this market. Now, from a short-term perspective, that can certainly hold for a little bit and for a while. From a long-term, and maybe even until we get new expansions coming online out of the Permian. From a long-term perspective, we expect that may be a little bit of a false signal, because we still expect a lot of pressure on the market, respective of how many rigs we have active relative to production. The other piece of this that Rob just noted here, and I'll just quickly touch on this, is the potential for DUC builds. Rob mentioned the Exxon piece. They've stated that they want a better level of DUC builds in order to manage how they produce and manage their operations. in our models, as we're running this, we're having to build ducts respective of IP rates and decline curves in order to keep our production number from exceeding that capacity number. Now, could we be off on the capacity number? Absolutely. So maybe we're not building as many ducts as we have inferred in this graphic here, where we're holding about 400 a day back because of our expectation that we are hitting a capacity limitation and we can't let production go above capacity, otherwise we would expect prices to fall. So we're holding some of that back with that anticipation of meaning or with knowing we needed to keep production back. So something we're watching on the duct sensitivity standpoint. Are we really building ducts? As Rob mentioned, EIA doesn't think so. We're having a hard time figuring out how that's calculated and how that makes sense in this market. Certainly from a basis standpoint, producers aren't necessarily incentivized to hold ducts. Basis isn't weak. Build ducts, basis isn't weak. However, Exxon said they do want a better inventory of ducts. We've also got new processing coming online, and we've got a couple of new pipes coming online at the end of the year, which we do expect will fill still. We're watching those, but PHP and Whistler, we still think that there's latent capacity available, latent supply available to fill that capacity relatively quick and put pressure back on markets. I'll quickly, just to talk about guidance here. I don't want to spend too long on this. I'm sure you all have perused through the guidance, but I think this is a helpful reference point. If you do not take the time to do this all the time, it's right here in front of you with the guidance from a BOE perspective there on the left-hand side, what the different public producers are saying. These public producers are about 52% of total Permian production. We expect, or if you look at their averages, it's about 5 to 8%. We expect our total rig counts among these operators to stay pretty consistent through 2023. You can see that on the right-hand side, just with respect to the various weeks in the month so far. So that begins at the beginning of the year. And what's hard for me to rationalize, and I think it's relevant to talk about here with respect to that 5 to 8%, is that, Permian growth? Well, if you think about last year, 2022, production was climbing out of the Permian pretty quickly. And so if you look at year on year, just real factual data, May of last year through May of this year, we were up around 17%. So in order to get back to 5 to 8%, that corollary, you'd have to actually reduce production by about 2 BCF. Well, that's not reality. That's not going to happen. So the reality is, and we're sitting somewhere around 15%. We're slowing production to bring it down to 15%. We're still filling PHP and Whistler at the end of the year, understanding that has less impact on the overall balance than if they started now. But we still expect a healthy clip of production growth respective of that 5 to 8%. So that 5 to 8% is not always a great, it's not the one-to-one corollary with how production is growing in the market per se. And you've certainly got a lot of other private producers in the market that, exactly.
Conquest, Mewbourne, Endeavor, all I think operating a combined 45 rigs or something like that. It's a high number.
Yeah. So again, just some perspective around that, because we certainly get the conversations about this and about how productivity is going. The last piece on the Permian, and then we'll get into a couple of longer-term LNG and longer-term thoughts, as to look at how that impacts individual systems within the Permian. You can see that in these charts, where those rig counts from some of the major operators and on the major systems are right there on the left-hand side, with Targa and EPD and ET getting, some of the DCP getting the bulk of a lot of those, the rig counts from public operators. And then switching over to the right-hand side, you can see that translate into our growth expectations for these various systems through 2023. So Targa being West Texas system being a big one. Some things to note here, we're trying our best to balance some of the offloading that these facilities are doing. Targa's growing, ET's growing. ET has to shift volumes from their Midland system over their Delaware system because they're running out of capacity there. They have some ability to do that, I think up to around 200 a day, if I'm not mistaken. So certainly some shifting. That's where we tend to sometimes look at a few of these systems in tandem rather than trying to isolate them from one to another because they have interconnectivity. Rob mentioned this, and you can see a link to the NGL network model there that's filling pipes like Sandhills and Grand Prix. So while the NGL network model as a whole, in the total takeaway of NGLs from the Permian is there's available capacity, there are systems that are growing very, very rapidly from a G&P standpoint that are vertically integrated with their respective NGL pipelines, and those pipelines are full. And so that's where those companies are potentially eyeing expansions and trying to figure out how they can get enough commitments to expand the pipe because they have the on-system production in order to fill their capacity and the capacity that's available to them. So some cool things to watch on the public midstream side, how that ties to producer guidance. There is a webinar we're going to be doing with RexTag and associated with RexTag. And the next week, you find that in the resources link, and there's a link later on where I'm going to dig into some of that and the producers attached to different midstream systems, partnership with RexTag to show some cool visuals on how that all works. So it should be a fun webinar if you guys are available to attend it. But Rob, anything on the midstream side, Permian standpoint, before we jump into LNG?
Yeah, the only thing I'd mention is if you don't get our plant data, please ask for it. You usually get a month or two of quarterly volumes before the company reports through state data, which can be very helpful in understanding how quickly plants fill up. Targa has their Midway plant in the Delaware and their Legacy plant in the Midland, Legacy 2 plant in the Midland that went on end of 1Q, also in 2Q. So it does give you a sense, and that data should be available in a few days, how quickly those plants are filling up. Justin also mentioned that the residue sample is not very good. Well, you can use plant inlet as a proxy for Permian production as another indicator. So if you don't get access to it, speak up. I think it does provide pretty good insight into a basin that doesn't have good residue sample.
Let's flip gears. This is always a good update, and I think a big thing that we're going to all be watching in the coming months and really years is an update on where LNG is. A lot of discussion on the ramp of Golden Pass and Plaquemines. We moved Plaquemines up based on some of their commentary and how fast they could go. And then I know there's still discussion on, and I mean, this is a new world for LNG in terms of how these facilities are built. Some of the offshore, the floating LNG facilities are certainly different than the older school facilities that we already have in place. We still have a significant build, as you can see in that second red circle, of longer-term LNG that's non-FID'd. So we'll talk about some of that here on the next chart, but we have that ramp coming up. So still watching how quickly these things ramp. That's a pretty steep curve, so it's a risk point in terms of our analysis of how quickly can these things ramp. We are still seeing SPAs come online, which are get signed, so we'll talk about that here in just a second. And then again, this data is all available. You can see the click here at the bottom. You can look at that in our SPA LNG stuff in our macro S&D, and all of that's available. So I just wanted to give some perspective on the ramp because it's helpful. And as we dive into this next one, it's good to see about what our expectations are and what facilities we have coming online. In that bottom table, you can see that the facilities we have coming online that are FID'd are in the box there. And then below that are those non-FID facilities, the ones that we still are building into our model to date. Certainly we expect Rio Grande to get FID'd any day now. They're 100% committed with some recent commitments. Metro Global continues to make headway and has this quarter with respect to getting up to 46%, a little bit of Delfin LNG as well. Their floating LNG facility has gotten some commitments. You see that in that right-hand chart, 2.7 BCF per day of commitments so far in 2023. So a lot of discussion earlier this year as we were doing our market update about inflationary pressures, and we're going to have to re-sign SPAs. And I think those conversations are absolutely still relevant. This is by no means but to say that, that's all washed out the door. It's just to say we continue to plow forward, and you can see that the Europe side of things has certainly been a leading factor this year, especially with the CEFI commitment and with the commitment to Venture Global. So those have been leading the charge and helping to drive additional SPAs into our balance and getting more firm around could some of these facilities be FID'd and come online. So just an update here. Again, all of this stuff is in the macro S&D and can certainly speak to. You can peruse through the data and ask our team questions. As I said, they love to answer them. So now let's flip into two last charts here, and then we can take some questions. Again, if you have questions, please type them into the question box. If you don't want to ask questions, certainly you don't have to. You can call us, and that's the good thing about our service. So I wanted to talk about, I'm going to bring our map up again. So I'm going to build this out just very quickly here, but how the West got weak. And this is something we're watching very closely with respect to the development, is as all this new infrastructure comes online this year and next year, so 2023 and 2024, what happens is we expect the Permian to fill most of those pipes. And all of that gas, whether it's redirected from other systems out of the Permian or whether it's additional production, will flood across into West Texas, into the Houston Ship Channel area, into the South Texas area. As we talked about earlier, we need the Haynesville to stay relatively flat and even potentially decline depending on what demand markets do. So if that happens, that means all that Permian gas will need to shift over and fill the new demand, because we don't expect a lot of new demand along the Texas Gulf Coast. The new demand is in Louisiana. Well, here's the problem with that. When you look at, historically speaking, in that chart on the bottom right, there really isn't any capacity to get it there. It completely filled up last year as Permian production increased and it had nowhere to go. Basis started to blow out. You can see that in that line there. So we really got Western markets getting weak and Houston Ship Channel getting weak. And so as that gas comes across and is trying to feed that new demand in the LNG facilities, and Louisiana isn't ramping up because it can't ramp up because we can't have outright prices rising, you get this sort of pressure that sort of squeezes gas out and around the horn. There's certainly more capacity available across the northern part of Texas. You're going to have plenty of pipes to feed that back down through because you've built all this Haynesville infrastructure to carry gas around. So we're going to see that squeeze where Western markets get weak to incentivize gas to move around the horn and go into those LNG facilities. So that's sort of a near-term scenario, meaning next year, of these Western markets potentially getting weak because you've got this barrier, not a hard barrier, mind you, because there is capacity to squish gas around via gas that's coming down from NGPL and Houston Pipeline and Gulf South. That's coming down from that sort of Texoke area in northern Texas and northern Louisiana. So there is the ability to squeeze some of that gas around, but you'll need prices and markets to reflect that. So we're watching that. I don't think that the current curves are probably weak enough. I think last time I looked, it was about 20. Like Houston Ship Channel was about 20 cents back next year. So something to watch, something for you all to look at individually and see, is there something there. And longer term, if you flip to the next phase of this, as all those LNG facilities build out, there's another dynamic that plays out here, and the need for new infrastructure. So bear with me for just a second, because I want to describe this graph's constructed a little bit differently, and I don't want to. It can be a bit confusing, because what we did here was looked at in red. The red line is the ability, the new capacity that's coming out of the Haynesville to serve new LNG demand, whereas the area is demand in South Louisiana. So as demand in South Louisiana picks up, you can see that first circle is where we were pushing all of that gas from East Texas into South Louisiana to meet demand because the Haynesville couldn't serve it. And you saw that in basis markets for the Haynesville. They got really weak because they couldn't get down into the southern Louisiana to feed. They couldn't get out of northern Louisiana. Going forward, as Golden Pass and Plaquemines come online, prior to like NG3 coming on, Momentum's pipe coming online, which is some of those upticks you see in the middle of the graph there. Depending on how fast those facilities ramp, you may or may not have enough capacity. So we're watching next summer a little closely, because if those facilities ramp too quickly, they're going to need to pull gas off the grid in a different way. And I could see the Southeast Gulf market getting stronger in order to pull gas that would, let's say, normally go up Transco to the Eastern Seaboard. I could see it pulling that gas back down because they need it in Florida, especially during the summer. They need it in Florida. They need it in Louisiana. They need it in Mississippi. And so I could see those markets getting strong. But that's a little tight, as you can see. Those, it's not like a definitive, and certainly not as definitive as the longer-term trend, where as we see continued LNG growth, there is not enough capacity to feed both local demand, get gas from West Texas, or from Texas, across to Louisiana, nor get it from the Haynesville. So you're right at that line. And then long term, with growth in the later part of this decade, it goes way above the line. So we need more infrastructure in order to meet the needs of demand in southern Louisiana, especially respective of that LNG ramp. So it's a bit of a different way to look at how markets will evolve, by looking at the total demand in South Louisiana, respective of the ability of one of the main basins to feed it, which is the Haynesville growth. The capacity is not there, nor is it there for, let's say, Anadarko or another basin to feed through the Haynesville or feed through that southern route in order to increase the amount of supply available. So we're going to need more pipe, is the point, to feed LNG demand, specifically growing in southern Louisiana. So again, could we see a lot of that happen in going forward, could we see a lot of new infrastructure announcements going forward? I think so, absolutely. I was at a conference, Williams, I know, had talked about watching maybe some announcements from them. So that'll be interesting to see if they've got something else planned. They're certainly active in the Haynesville. They've also toyed with some stuff in the Permian. So we'll see what comes of them. But certainly something we're watching. But they're not the only ones. There's certainly been a lot of expansions respective of DTM and other players in the area who are looking at expansion. So again, something to watch out and something to watch for long term as a tipping point next summer, and then certainly longer term. So quickly, before we get into questions, we've got a couple of upcoming events. You guys can register. A great one with RexTag, where we're going to look at some of the key players driving production growth and the producers behind those, so the midstream and the producers driving those. You can click on the register here. It's also in the resources section. There is one we're going to do with, really excited about this one, with Arbo and then Gulf Coast Midstream. We're going to do that on the 19th, where we're going to talk about the value of storage, the potential for storage, some of the expansions that have been announced, the expansions that haven't been announced, some of the value of storage that maybe not being factored in the market. It's going to be a really good one. So I'd encourage you, if you're interested in storage at all, that's a really good one to hit on. And then the last one there that we've got currently on the schedule is a partnership with Bloomberg. So we're going to get on the phone with the Bloomberg BI guys and have a really good fireside chat about infrastructure growth and production and expansions and LNG in specific, and get some of their perspectives along with our perspectives, and have a good debate about where the market's headed. So again, register for that one down there at the bottom. Again, they're in the resources link. Another thing to watch out for, it's coming. We've got a new Energy Data Studio revamp coming. I know we just relaunched our portal. We've got another sort of a facelift on it. You might have noticed the graphics are a little bit different in this presentation than you might be used to what we're doing. It's a little bit of a preamble to what's going to happen here with Energy Data Studio and some of the new changes we're making. We have several new prototypes going on. You're going to get to check those out, meaning that we're going to give a lot of our clients access to some prototypes before they go, before we officially launch them as a product. So you get a chance to use them and play with them and see what value they might bring. We've got a FERC financial dashboard coming up where you can get access to all the FERC Form 2 and Form 6 data really quickly. We've got a GMP financial data. For any of you who played with our GMP systems, Rob mentioned before, where you're talking about production growth and outlook versus sample, and getting all the data, irrespective of a GMP, getting in the financials from our blueprints right into the dashboard, so you can get a quick take on the profitability of some of these GMP systems. And then we're going to supercharge our nat gas S&D dashboards, a whole new revamp of those to get more of the graphics in here. So watch for those. Those are going to be cool. A lot of streamlined navigation, changes of look and feel, access to all these webinar decks, rolling analyst first takes on and market events. Again, we're putting a lot of effort in helping to increase how you access our stuff and the value you get from that. And then, lastly, if you aren't signed up for our daily note, here's a QR code. There's the links. It's free. Please do it. Check it out. We'd love to help you. So I don't have a ton of time for questions here. I bet people are going to start to have to go off to other meetings. I know there's a lot of issue or, a lot of talk about basis. Certainly call in. We'd love to continue to debate this because I think it's a hotly debated topic. For Houston Ship Channel, there was a question with regard to pricing in Houston Ship Channel. I would expect, again, as you see from that last graphic, that Houston Ship Channel should continue to, in my opinion, continue to weaken as all that pressure comes across, and it has nowhere to go. So for 24 and 25, I haven't looked at Houston Ship Channel prices lately. I thought it was about 20 cents back, but please check my math on that because I just haven't looked at it lately. But I would expect it to weaken respective of all of that production coming across and not having any new demand sources or anywhere for it to go, but having to push gas out of its market that normally comes inbound and having to squeeze it around to where demand sources are, like the Haynesville, like Golden Pass and Plaquemine. So that's my expectation on Houston Ship Channel markets going forward. So a lot to talk about here. I appreciate those of you who hung out with us for another 2 minutes or so, which looks like many of you did. So thank you. We love having you guys as clients. We really appreciate it. We love the conversations. This is fun for us, and it's fun mostly because we have great clients that we really, really, really like to work with, and we really appreciate you and all the interactions that we have with you. So stay tuned. A lot of good webinars. Check it out afterwards. For those of you that asked questions that I couldn't get to because I'm long-winded, next time I will be shorter, and hopefully we can get to some more questions. But in the meantime, we'll get back with you directly to answer some of your questions and engage in a debate. So thank you very much. Have a great rest of your week. Stay cool in Texas to the best of your abilities. And we look forward to talking to you again.